So as you guys know, Baidu is often referred to as the sort of Google of China because they're the biggest internet search provider in the country and they have their toes dipped in many other businesses as well. But when looking at the stock, ticker symbol BIDU, it has been absolutely obliterated. It just hit a fresh 52-week low, and when looking at the past year, it is down well over 50%. So as a result, I've been getting bombarded with a lot of comments from you guys asking me to share my opinion on the stock. So in today's video, we're gonna do just that. I'm gonna share my opinion on the company, their business, their performance. We're gonna also take a look at the stock and the different reasons why it's been performing so poorly. And then we'll also talk about whether or not I think there's any future potential for Baidu, or if I think that the company is just sort of doomed to fail. And I'll even tell you guys if I plan on buying the stock myself anytime soon. So it should be a fun video. I hope you guys enjoy it. Thank you for clicking on it. Let's go ahead and get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. So let's go ahead and take a look at the stock. Let's kick things off with the stock and the different reasons why it's down, and then we'll transition a little later to my opinion on their future and what that kind of looks like. Okay, so as we can see here, even in the past 5 years, the stock is still down by 56%, which is absolutely horrible long-term performance. However, most of that pain has come recently in the past year, as they have tanked by an even higher percentage in just the past year alone, and are already down by almost 40% so far in 2019, while they currently sit at the very bottom of their 52-week range at just $95 a share, which is down from their 52-week high of over $230 a share. So this is by all accounts an incredibly beaten down stock, and it does actually leave a lot of potential upside if it ever returns to those levels. I suppose the bright side to all of this is that the valuation has gone a lot cheaper, with a trailing P ratio of only 7.4, although that does increase to almost 15 forward according to Yahoo Finance, meaning that Wall Street expects their profits to really tank this year, which we'll take a look at in just a second. And that ultimately seems to be one of the biggest reasons why this stock is performing so incredibly poorly. Now, if we take a look at their financials for the past 4 years, you won't really find anything to be worried about, as sales actually grew from around $10 billion in 2016 to almost $15 billion just a couple years later. And even though their net income took a dive in 2016, it quickly recovered to bring in over $4 billion last year, which is a pretty large amount of profits in relation to that revenue. However, the problems are mostly with what's happening right now and what's expected to happen in the near future. For example, in their last quarter, they actually reported the first quarterly loss of net income in 14 years. That's a big deal, meaning that this company used to be very profitable by a wide margin for a very long time, but has recently seen some major struggles that have impacted that. In fact, their net income dropped from positive 6.7 billion RMB in the year ago quarter all the way down to negative 327 million RMB this latest quarter. So that's a huge drop. And there's really a couple reasons for this. The first is that their advertising business, which has seen tremendous growth in the past, has slowed down dramatically to just 3% growth in their latest quarter year over year. Now, the crazy thing is that despite their advertising business making up around 73% of their business, they were still able to grow their total sales by about 15% year over year. And that's entirely due to their other segment, which is appropriately called Other, that jumped massively by over 70% year over year, which is mostly due to their subsidiary company called IQ, that is often referred to as the Netflix of China because they do a lot of like streaming video content in China, who grew their sales by 43% year over year. However, while IQ is providing Baidu with a ton of revenue growth, they're also the main drag on Baidu's profits. See, just like Netflix, IQ has to spend an enormous amount of money on not just content licensing, but also content creation, which can be extremely expensive. And the problem is that Baidu basically subsidizes a lot of those costs themselves. And when looking at IQ's cost of revenues, they increased even more than their sales did by around 50% year over year. And if you think that's scary, take a look at this one. Their net loss increased by over 350% year over year. So there's no doubt that IQ is really dragging down Baidu's profits, who up until now used to have a very high margin, profitable business, thanks in large part to their online advertising sales. But that's ultimately another issue that Baidu faces, given that the weakening Chinese economy coupled with the US trade war has led to most Chinese companies tightening their advertising budgets in an effort to cut costs and try to survive the very difficult macroeconomic headwinds that they're currently facing. And in turn, this has led to much lower advertising sales for Baidu, which are usually very high margin, and you couple that with the rising losses in other parts of their business, like what we're seeing with IQ, and you're left with a very difficult situation for Baidu, at least in the short term. So much so that analysts think that Baidu's revenue will only climb by less than 1% this year before returning to higher growth in 2020 at almost 15%. And again, because of the drags on profitability, they're expected to see their EPS drop by a massive 71% this quarter, 53% next quarter, and 58% for the year, before having a substantial recovery in 2020 of 58%. But again, that's coming off of much lower performance the year prior. And even then, Yahoo Finance still projects their 5-year growth average as a negative percentage, which is probably linked to all of the uncertainty surrounding their business at this time. Okay, so that's pretty much where we are right now. Things are looking very dark for Baidu, at least in the short term, and the stock is getting punished by Wall Street as a result. But it does also look like analysts might be a little more optimistic about the future. So if that's the case, then it only makes sense that we take a look now at what their future potential looks like, and then I'll kind of end the video with my overall conclusion on the stock, and I'll let you know if I plan on buying anytime soon myself. So let's go ahead and do that now. Okay, well, perhaps the most obvious place to start is by taking a look at IQ to see if they have a shot at becoming profitable next year. Well, at least according to Yahoo Finance, they're still expected to post negative earnings through 2020, although to be fair, they do look like they're improving quite a bit, as they had negative EPS of $2.53 last year, but are expected to have a smaller loss of $1.83 this year, and then it should be even lower at $1.19 next year. So while it is still looking negative, their EPS is at the very least expected to improve a bit. In fact, its growth of 28% this year and 34% next year. And all the meanwhile, they should continue growing their sales by large amounts as well, at about 15% this year and 23% next year, which can definitely help offset a lot of that revenue slowdown in Baidu's advertising business while the economy is weakening and the trade war rages on. So if you're on the bullish camp of Baidu, you might be arguing that this is a necessary investment for their future, considering that IQ already has almost 100 million subscribers just in China alone, while Netflix is higher at 150 million, but that's globally versus IQ mostly being only in China. And if we go back to Baidu's business, they remain the dominant search provider in China with over 65% market share of the desktop market and over 71% of the mobile market as of the start of this year. And they're also spending a ton of money on research and development, which increased by 26% last quarter to keep their innovations growing in areas like cloud computing, with Baidu Cloud, which just entered the top 5 ranking in China versus other providers, while they continue to grow their capabilities in artificial intelligence, machine learning, deep learning, and they even have their own version of Amazon's Alexa with their Duer OS platform that has grown its install base by 279% year over year. And that could be a big deal because those platforms tend to collect a lot of like user data and stuff that is very valuable as well. Not to mention that they're also one of the biggest plays on autonomous driving in China with their Project Apollo platform, which I believe is the first of its kind to already launch trial versions of a robo-taxi service in the country. And that could be a huge deal in the future, given that the ride-hailing market in China alone is expected to nearly double from around $50 billion this year to almost $100 billion in just a few years, according to Statista. Not to mention that autonomous platform providers are expected to do a lot of money in the future. Like ARK Invest projects that market to be worth trillions of dollars in the future, but that's kind of globally as well. So you'd have to kind of take that with a grain of salt, I guess. Now, even though that they're seeing a slowdown in advertising right now, that market in China is also expected to break north of $100 billion soon, with digital ad spending making up more than 70% of all advertisements. So given that Baidu is already the leading search provider similar to Google, who we all know is the global leader in the advertising market, I think bodes very well for Baidu's future. So do I plan to buy this stock anytime soon? Well, that's a tough one to call, guys. On one hand, I definitely don't like the fact that IQ can have such a substantial impact on Baidu's business because, in my opinion, I still consider IQ to be very speculative because they continue to post substantial losses. On top of that, I don't even know much about the video streaming market in China, but here in the US, I'm not even really a big fan of what something like Netflix is doing because they're spending a lot of money on content creation, but now we're seeing bigger companies like Disney and AT&T enter the space, and they come with a whole backlog of content that they've already created in the past. So the fact that Netflix is trying to compete with that, I'm not really a fan of Netflix. I'm actually very bearish on Netflix. But when looking at China, I really have no idea what that market is like. I don't know what people like to watch. I don't know what their content is like. I don't know if most of their content is just licensed from stuff from like Western markets. I really have no idea. What I do know is that there is competition there from companies like Tencent and Alibaba. And for me personally, I'm actually planning on buying Alibaba stock and Tencent stock as the trade war kind of hurts those stocks as well. So I already have a lot of exposure to the Chinese market, and I also have some exposure to the video streaming market because of companies like Alibaba and Tencent. And again, that's a market that I don't even fully understand. I'm not very knowledgeable about. So I don't know if I want to increase my exposure to those areas and increase my risk. But on the other hand, IQ is also growing their sales by very high amounts. They have a very large subscriber count, and analysts do think that their losses will improve in the future. I don't know that they will, but that's kind of what's expected to happen in the future. So this could actually end up being a good investment for Baidu, but in the meantime, Wall Street seems to hate everything that's going on, and this stock just continues to tank. So by all accounts, this stock has pretty much been a falling knife, at least up to this point, and calling the bottom is going to be very difficult to do. I have no idea where the bottom is, but if I'm thinking long term, and I look at Baidu's business and I look at how dominant they are in certain areas, especially search, and we look at a trade deal possibly getting done at some point, I'm still optimistic about that. We're talking about the two largest economies in the world. They have to learn how to play nice at some point. So when a trade deal gets done, I would have to assume that consumer confidence and business confidence returns to China, budgets go up, and spending on advertising goes up, and Baidu could return to very high growth in the future, especially with their investments in other areas like artificial intelligence and machine learning and autonomous driving and all these other different aspects or different parts of their business. So from that standpoint, if I'm thinking long term, this could have ultimately proven to be a buying opportunity. Even if the stock continues to go down, if I was to buy it and kind of average down even more, this could have ultimately been a buying opportunity if it's later trading at $200 a share or something like that years from now. But the issue is that there's still a lot of risk to this because you have to understand all these markets, which I'm not very knowledgeable about all these Chinese markets. I have some exposure through Alibaba. I'm now starting to buy Tencent, but I fully expect Alibaba and Tencent to both drop in share price with the whole trade war, and I'm planning to kind of average those positions down for long-term investments. But the thing is too that we have no idea when a trade deal gets done. It could get done tomorrow, it could get done next year. We have no idea. So if you're someone who can't really stand risk and can't really stand volatility, then this definitely is probably not a stock for you because it could definitely continue to sink. At the same time, some optimism could enter into the market and the stock could take off because it's been beaten down so much. So in my opinion, it's more of a high risk, high reward type of stock. And it's also a stock that I'd be more willing to buy if I didn't already have so much exposure to China. But because I already have some exposure and I'm looking to increase that exposure through other stocks, picking up Baidu would just add to that. And I'm not sure that that would be a good strategy for my portfolio. So it's a stock that I will definitely keep a very close eye on because it definitely has my attention at these prices. But if we were to say that the stock continues to drop, maybe it drops to the 80s, maybe the low 80s, at some point it becomes just too attractive for me to ignore anymore. And then maybe I do pick up a small position, but I'd have to definitely be thinking long term with this one. Like I said, there's many parts to this. You'd have to really do your research before even thinking about buying a stock like this. But anything can happen. Now, Baidu will be announcing earnings, I believe, at the end of this month. And that will be a critical thing to look out for because this is already a very volatile stock. So by the end of this month, this stock could be up a huge amount. It could be down even more. Anyway, that's just kind of my thoughts on it. If I ever do plan on buying Baidu stock, I will absolutely let you guys know with an update. And I think that's about it. Make sure you leave your thoughts and comments down below. Who cares what I think, guys? I'd love to hear your opinion on Baidu stock. I know a lot of you are investing in it, and I know a lot of you are very bearish on it. So it's also a pretty polarizing stock as well because it's been very volatile too. But anyway, I hope you guys enjoyed the video. Thank you so much for watching. Make sure you hit the like button if you enjoyed it. It really helps the channel, and I'll catch you guys in the next one. Take care. Bye-bye.